I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, our weekly look at the world of business and finance. This week, the economies of North Africa. What looks like political unrest in Tunisia and Egypt actually has economic beginnings. We'll explore what's given rise to unrest.
I'm Stephen Cole at the World Economic Forum in Davos, where everything from Tunisia to national debt is on the agenda. There'll be more from me later.
And can you simply blame the snow for a terrible quarter of UK economic growth, or is the coalition's plan to cut coming unstuck? But let's begin in North Africa. The protests have been all over our screens in the last few weeks, by and large calling for the downfall of governments, first in Tunisia and then Egypt. But characterising these as political protests is a little too simplistic. Their beginnings are in fact economic. Simple things like escalating food prices, a lack of jobs. They make people angry. In Egypt, thousands of people were out on the streets in protests, and it made investors nervous too, we have to say, very nervous. The stock market racked up one of its biggest one-day losses. Trading was suspended for a time, and the cost of insuring Egypt's debt soared to an 18-month high. Behind these protests, same thing again, jobs, rising food prices, and the appearance that the rich are simply getting richer while the poor are getting poorer. While in Tunisia, the anger was enough to unseat President Zine Al Abidine Ben Ali, a man accused of getting rich at the expense of the people. Under his reign, there was much talk of corruption, with his favoured circle getting a cut. In fact, the watchdog group Global Financial Integrity said the amount of illegal money lost from Tunisia due to corruption, bribery, kickbacks, trade mispricing and criminal activity between 2000 and 2008 was on average over $1 billion a year. And Ben Ali's own family don't escape the allegations either, with his own daughters and his wife's family benefiting substantially from private business. His daughters and their husbands from his first marriage have stakes or own Mercedes dealerships, also pharmaceutical companies, and are in the management of airport services. His daughter from his second marriage also owns exclusive car showrooms, Audis, Porsche, Volkswagen. Ben Ali's brother-in-law has business interests in Ford, as well as major media outlets and the Bank of Tunisia. All the while, the picture for the rest of the country looks like this. Unemployment, a major driving force behind the unrest, was, under Ben Ali, claimed to be at 14%, but Ezzeddine Labi, a former World Bank economist, says it's more likely to be closer to 20% for graduates and actually up around 27% overall. So as the dust settles in Tunisia, what are the future economic implications for this country? Let's discuss that with Anthony Skinner. He's the Associate Director and Principal Analyst at the risk analyst group Maplecroft. Anthony, thank you for joining us. Let's just start with the economic undertones to these protests in North Africa at the moment. Talk me through the biggest issue, economically speaking, that we see in Tunisia, for example.
One of the key factors, I would say, is Tunisia's relationship with the EU in terms of the country's dependency on exports, on FDI, and remittances also. I'd say actually that the fact that 3/4 of these different economic elements that they come from the EU make it particularly vulnerable to fluctuations in the European Union area. This has been particularly notable in 2008 and 2009. And this obviously has a significant impact on employment levels and the amount of employment that can be generated in Tunisia. Again, when you look at the question of employment and the lack of new employment opportunities, one question is the highly educated workforce in Tunisia itself. The year 2000, around 20% of the Tunisian population had a higher educational degree. That figure actually increased to above 55% in 2009. And the question of demand and supply, again, as I said, basically that a lot of the jobs available relate to tourism, as I mentioned, and textiles, and that a lot of individuals, particularly the youth, feel that the opportunities are not there for them to actually be able to use their qualifications. So they either do not take up jobs or take up menial jobs beneath them, and that also has a role to play in explaining the level of unemployment in Tunisia.
Okay, so it all paints a pretty bleak picture. Is it enough to put people off investing in Tunisia full stop, do you think? Or if they do decide, yeah, we're going to go in and invest, what sort of risk analysis do they have to undertake?
Well, it's quite interesting to see, for instance, in the case of Tunisia, British Gas has said that it has no plans to actually change its investments or its profile in the country, and I would say that that applies to a number of investors in Tunisia itself, those foreign direct investors. You could say that the outlook, okay, it's unpredictable in Tunisia, but equally, if Tunisia does experience a shift towards a fully fledged democracy, which would be a revolution of sorts, then this would be obviously welcomed by the investment community. It would mean greater accountability, it would mean greater transparency, and all these factors obviously play a positive role in terms of investment considerations, as has been seen in Turkey under the AK Party. So I think there is definitely an element of risk-taking, and that will be reflected in the fluctuations of the stock exchange obviously being hit in parts of the Middle East, the MENA region. But obviously there's a risk calculation that needs to be taken. And if the returns are great, if the risk is worth being taken, then I'm sure a lot of companies with a presence in the country will take it. The question is whether new investors that were planning to actually invest in some of these countries will stall and take a wait-and-see attitude, as might, for instance, be the case in Tunisia, until things settle down.
Just finally, Anthony, Egypt, which is where things have in a way spread to. What are the differences between Egypt's economic issues and Tunisia's, or are there differences?
Egypt is interesting. I think one of the key factors, of course, in Egypt is the being able to mobilize the mass of the populace, not just the middle class, but the masses, as was seen in 1977 with the bread riots. When there are fundamental issues at stake which affect the livelihoods of individuals, then this is a particularly dangerous situation. And it can be said that with food prices at an all-time high in January, at least, that this is obviously a concern to the Mubarak regime. As a further point, I would say that the Muslim Brotherhood, okay, it's lost some of its traction. It didn't partake in the second round of elections last year because of the tactics used by the ruling party in order to discourage it and the level of oppression that were actually applied. But at the same time, Egypt does have a possible alternative, whether that's in the form of the Muslim Brotherhood, Al-Ghad and Al-Baradei. So this may also be taken into consideration. When you look at Tunisia, for instance, the opposition is very fragmented. It's been weakened over years. There's a lot of internal quibbling, and that has also occurred to a certain extent in Egypt. But I would say that maybe the fact that at least Egypt has had an opposition, albeit ineffective, the Muslim Brotherhood obviously having strong grassroots support, suggests that maybe somehow this has somewhat at least diffused the immediate tension.
Now to the World Economic Forum in Davos, a place for deals and talks, and this year perhaps an acknowledgement too that the world's economic power is shifting to the east. For the 2011 summit, record numbers are coming from the 4 BRIC nations, as they're known: Brazil, Russia, India and China. About 365 delegates all up, according to Bloomberg. What they have to do, though, other than look after their own interests, is try to figure out how to get this global recovery back on track. Coming up, we will go to Davos itself. Stephen Cole is there for us. He'll be speaking to the second-in-command at the IMF. We also go to London for economic analysis from Trevor Williams, the chief economist at Lloyds Bank, on the cut versus spend theory, which has reared its head again because there was some nasty economic news out of the UK this week. Negative quarterly growth, putting the country on the precipice of a double-dip recession or worse. Let's begin with this report from Paul Brennan in London.
The UK Treasury is blaming the weather, but the latest GDP figures show the snow wasn't the only thing falling at the end of last year. As the blizzards crippled transport links, retailers suffered their worst December in 12 years. Still, most predictions had been for GDP growth to continue, albeit slowly. Opposition politicians say the contraction is evidence that Britain could be facing a double-dip recession. Nonetheless, the UK Finance Minister is holding firm.
We're very clear that to change our budget plans on the back of these weak figures and the bad weather would be a huge mistake, because that would push us back into a financial crisis.
In the second quarter of 2010, the UK economy had grown by 1.1%, but slid back to 0.7% in Q3. and analysts predicted it could slow to just 0.1% for the fourth quarter. In fact, a dramatic slide into negative territory caught everyone by surprise. The construction industry was particularly weak, down by 3.3%. The massive services sector shrank by 0.5%, but manufacturing actually grew by 0.9%. Now, these are just provisional figures based on initial data, and a more accurate figure for GDP will be released next month. But with $100 billion worth of government tax rises and spending cuts in the pipeline, expected to result in hundreds of thousands of public sector job losses, the prospects for growth here in the UK for 2011 look decidedly difficult. There's even talk of stagflation.
Well, stagflation is where you have no growth, or in fact falling growth, and at the same time rising prices. That's inflation, and that's really damaging to an economy. It's damaging because inflation erodes the value of money, but at the same time there's not an expansion of prosperity within the overall economy.
There was some good news. Government spending in December was $26.5 billion, much lower than the $33 billion expected. But confidence has been shaken in the private sector's ability to pick up the slack as the public sector shrinks.
So let's expand on all this now with Trevor Williams, who joins us from the UK, from London. He is Chief Economist at Lloyds Bank Corporate Markets. Trevor, the expectations were 0.4%, 0.6% for the quarter. It was the complete opposite. Were you surprised by that?
I've got to say, Kamal, I was surprised by the extent of the fall, but we weren't surprised by the sharpness of the slowdown, because our own proprietary data, we do monthly surveys of businesses, and it had been showing this survey that there would be a sharp slowdown in UK GDP growth. And we were looking for something between 0.25 points at best in the quarter. But we were surprised that it was so negative, no question.
Am I being fair in saying that blaming the snow, though, as some people have done, is just, it's a little bit much? I mean, yes, snow is bad for sure, but you surely couldn't blame it all on the weather.
No, it was not all the weather, of course not. And the figures showed that anyway, because the Office for National Statistics gave an estimate of the quarterly figure without the snow effect. And that figure was flat. In other words, zero growth in the quarter, even taking account of the snow. The snow took 0.5% off growth, but the economy had slowed anyway from 0.7% growth in the third quarter to zero growth in the fourth quarter. In other words, a sharp slowdown was underway despite the weather.
And does that come down to the budgetary measures taken by the coalition government in the UK? Again, is it too simplistic to say that the budget cuts have done this? Austerity is what brought the slowdown?
It's too simplistic. It's not the cuts, because the cuts haven't yet started. The cuts start from the first quarter of this year.
What do you make of the austerity versus stimulus argument? It has been covered a lot. Certainly on this program we've covered it a lot. And I think the argument is very much still alive, whether austerity or stimulus was the right way to go for the UK and for Europe more widely.
Well, I'm afraid that it's too simplistic once again, because you can only borrow if the markets are willing to lend money to you, and they're only willing to lend money to you if they're convinced about your solvency at low rates. So the UK borrows at pretty low interest rates. If you look at our long-term bond yield, it's very low, 3.5%, compared with, say, for Greece or Ireland or Portugal or Spain, twice those kinds of rates. And the question has to be, if the UK had not embarked on a plan to cut the fiscal deficit in the medium term, what would have happened to its borrowing costs? Would they have remained so low? And the answer is probably not.
All right, Trevor Williams with us from London talking economics on counting the cost. Thank you, Trevor. Right, so let's move to Davos. Now, we mentioned before the World Economic Forum going on there. Stephen Cole is there for us. Stephen, all this stimulate versus austerity stuff must still be a big talking point there too.
Thanks very much, Kamal. Davos has been described rather cynically as a rich man's club, and there's no doubt there are a lot of rich people here. But they represent, if you like, some of the old economies, because this year is all about an emerging rich man's club. That is, the the BRIC economies, Brazil, Russia, India and China. And their delegations are twice the size of last year's teams because they've come here to take central stage. They know how important they are. Trade unionists have come here as well, and also the International Monetary Fund. Its star has been rising because of its rescues from everywhere from Hungary to Pakistan. And earlier I talked to the Deputy Managing Director, John Lipsky. Mr. Lipsky, how much money has been set aside to save the euro?
Well, right now, the limits are rather theoretical. We have said that we would participate with our European Union partners in any operations needed on the kind of a 2-to-1 basis that we've been participating already. And the European Union is deciding on how much their own funding limits would be.
How would you describe the crisis facing the eurozone?
Well, there were some peripheral countries that ran up egregious problems in the wake of the crisis.
You're talking about Greece
and Ireland.
Portugal, Ireland.
Greece and Ireland have been egregious and have been dealt with programs, with innovative and very strenuous programs that so far are on track. Other countries that have been under strain have adopted new policies, and the European Union itself has adopted new instruments and new arrangements to give greater credibility and stability.
Are crises like these good business for the IMF?
We're in business to avoid crises if possible and to help solve them. So we're happier when our clients are in good shape and happy.
Now, earlier I talked to Andrei Kostin. He's the chairman and the CEO of VTB Bank, which has ambitions to expand right across the Middle East. And I asked him to comment on President Medvedev's speech. Mr. Kostin, what was important about the president's speech?
Well, definitely Mr. Medvedev addressed Davos this year to be the first Russian president actually speaking at Davos. I think he addressed the most urgent international issues, most urgent or most important international and global risks. And I think that is the subject, the main subject of Davos. I think there's a lack of global governance, which we definitely see as one of the major risks. And I think Russian president is just saying that Russia is very much involved in making progress together with the rest of the world on this and ready to address the most important issues. He also spoke about Russia because Russia does want to be more involved in international cooperation. Russia does want more international investors. Russia now in the process of larger modernization of the Russian economy, bringing innovative technology, changing the nature of the Russian economy from oil-dependent country to a modernized society.
This year's theme is trying to agree or share the norms of the new reality. What do you detect the new reality is?
Well, I think it's quite evident from the agenda of Davos that we are more and more talking about different kind of risks, which we didn't do, let's say, 2 or 3 or maybe 5 years ago when we talk about the way of development or different opportunities. I think the crisis led us to this situation where we now very much concerned of what might be the next crisis, and the next crisis might be deeper if we don't resolve the issue of global risks. And they include the risk of lack of natural resources, for example, not only oil and gas, but for example, food and water, or it's a risk of a very large economic disparity between the countries or inside different countries, between wealth and poor, and it also employs risks of dark economies, of drug trafficking, and other things like this.
Corruption, exactly. Do you detect a widening of the gap between rich and poor, not just in the developed nations, but in the emerging nations as well?
I don't think so. I think, my opinion, that modern society, actually, and in Russia particularly, I mean, there was quite a good growth of real income of population, and Russia, for example, government spent a lot of money on increasing the pension funds and all these things. But of course, we're now addressing a very severe issue of unemployment, for example. The level of unemployment is unacceptable, both in the United States, in Russia, in Europe. So that's definitely definitely quite an important issue, very much related to the poorness of people.
Do you see that as one of the causes of the unrest in Tunisia and Egypt?
Well, very much so. I mean, we also see it as probably one of the major causes of terrorism in Russia, and that's why Russia thinks that, I mean, to resolve this issue, really need to develop the economy in this region, investing more money, creating more jobs in this region.
What we heard at the forum in the last few days made for grim listening as Europe's bailout strategy, designed to, if you like, calm the financial markets, was described as a little bit of a failure. What they're trying to do is place a firewall between the centre of the Eurozone and the periphery, and that doesn't seem to be working at the moment. Investors are becoming more, not less, nervous. Now, Sir Martin Sorrell, who is one of the world's greatest ad men, said this. He said that although business last year was good and CEOs are forecasting good times to come, those same CEOs are also a bit reluctant. They've been spooked about capacity and about job creation. And job creation is one of the keys to the economy being pulled out of the doldrums. It's also one of the keys, of course, behind the unrest in Tunisia and Egypt. And if that social unrest spreads from the Maghreb, from North Africa into Central Europe, then we'll have a whole new discussion here at the World Economic Forum next year.
Yes, we certainly will. Stephen Cole there in Davos, thank you for that. Let's move on. US President Barack Obama delivered his State of the Union address this week, where he pledged to lead the nation against the rise of emerging markets. This is how he put it.
We know what it takes to compete for the jobs and industries of our time. We need to out-innovate, out-educate, and out-build the rest of the world.
And while suggesting investment in education, he'd also said he would tackle the nation's debt. But Republicans weren't impressed by Obama's plans to freeze parts of his spending plans, noting that represented just $400 billion of the nation's $3.5 trillion budget last year. And worse was to come. The congressional budget deficit said that the budget deficit this year would rise 40% to almost $1.5 trillion, mostly due to Republican-backed tax cuts for the wealthy. Just to remember, though, why these debts are here, or at least one of the major reasons, the massive spending on bailing out the economy after the financial crisis, which was, let's not forget, the worst since the Great Depression more than 70 years ago. Just who was to blame for that crisis? Well, according to the Financial Crisis Inquiry Commission, pretty much everyone, from Wall Street to the financial regulators to past governments, Democrats, Republicans, you name it. Nick Spicer has more.
It could have been prevented. That's the conclusion of the commission looking into the biggest financial crisis since the Great Depression.
None of what happened was an act of God. The greatest tragedy would be to accept the idea that no one could have seen this crisis coming, and thus nothing could have been done.
The report says the people who should have done something included government regulators.
On and on and on, regulator after regulator, they either chose not to act or turned a blind eye to what was actually going on.
Also blamed the giant bonuses paid to Wall Street bosses.
Compensation systems in an environment of intense competition and light regulation rewarded the big bet, where the payoff on the upside could be huge and the downside ignored.
The financial crisis started when millions of subprime loans began to turn sour. That caused banks and government lending agencies to topple and Wall Street to panic. The chairman of the commission said the crisis has left 26 million Americans without work or caused them to give up looking. It's destroyed $11 trillion of household savings, and 4 million people have had their homes foreclosed. The report suggested more regulatory steps needed to be taken to avoid another crisis.
We hope that this will be a guidepost to policymakers and the public as our financial system is reformed, and that journey has just begun.
The commission was mandated to turn over evidence of criminal wrongdoing by the companies and people it talked to, and it did so. But members wouldn't say who or what companies might be in trouble with the law in the months to come.
And that is just about it. Don't forget to get in touch, though. Twitter's the best way to do that. At AJ Counting Cost is where you'll find us. We put pointers to next week's show there. Plus, feel free to send in your questions and suggestions. We will happily take those. Also, you can go to our website, There it is at aljazeera.net/English. You click the business tab, follow the links to the Counting the Cost page. We put previous shows and blogs up there as well. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.